In the summer of 1999, nearly every major investment bank on Wall Street had an analyst covering the internet sector. Nearly every one of those analysts had a buy recommendation on the stocks they covered. The consensus was so overwhelming that dissent had become professionally costly. The analyst who questioned the valuations was the analyst who had misunderstood the new paradigm, had failed to grasp what the internet would become, and was advising clients to miss the decade's defining investment opportunity. The consensus was unanimous. The consensus was wrong. The dot-com crash between 2000 and 2002 wiped out approximately $5 trillion in market value. The unanimity of the consensus was not evidence that the consensus was correct. It was evidence that the social and professional pressure within a specific community had synchronized a set of beliefs into alignment without the rigor of independent evaluation that would have revealed the misalignment between those beliefs and the underlying reality. This is the specific mechanism behind the false consensus effect. Consensus feels like validation because humans are social animals who evolved in environments where the agreement of others was a reliable signal that a belief was grounded in shared observation. When everyone around you believes the same thing, the most natural inference is that the thing is true. The inference is reasonable in most social contexts. In organizational and market contexts, where the people reaching consensus are operating under the same information constraints, the same social pressures, and the same incentive structures, the consensus is often evidence not that the conclusion is correct, but that the conditions for groupthink are present. Consensus is a social phenomenon. Truth is an empirical one. They have no necessary relationship, and the organizational contexts in which they are most likely to diverge are exactly the contexts: high-stakes decisions, high-cohesion groups, time pressure, leadership signals that feel most like the conditions under which consensus should be trusted. Groupthink is a phenomenon that has vexed corporate boards, leadership teams, and government committees alike for decades. It refers to a breakdown in critical thinking that occurs when members of a group prioritize consensus and cohesion over rigorous analysis of alternatives. Under the sway of groupthink, even highly intelligent and well-intentioned teams can make irrational or catastrophic decisions because dissenting viewpoints are suppressed and warnings are ignored. The psychological mechanism that produces false consensus is well documented. Since the members of a group reach a consensus and rarely encounter those who dispute it, they tend to believe that everybody thinks the same way. Additionally, when confronted with evidence that a consensus does not exist, people often assume that those who do not agree with them are defective in some way. The second part of that finding, that people confronted with dissent from a consensus tend to attribute the dissent to the dissenter's deficiency rather than to the consensus's error, is the specific mechanism that makes false consensus self-reinforcing. When the person who disagrees is assumed to be wrong, uninformed, or motivated by something other than genuine analysis, the consensus is protected from the information that would challenge it, and it can be maintained indefinitely past the point at which it corresponds to reality. This is the specific mechanism that the Boeing 737 MAX case exemplifies most precisely. Within Boeing, there was one-voice messaging, meaning any reports or presentations emphasize the positive and buried negative evidence, and a pattern of dissent thinning out as the program progressed. Early warnings or concerns about pilot training, needs for the MCAS system gradually disappeared from discussion, as if everyone convinced themselves these issues were not serious. This is a hallmark of groupthink. Risk signals were rationalized or not escalated, creating a false consensus that all was well. The consensus that MCAS was safe was not reached through an honest evaluation of all available evidence. It was reached through a process of social pressure in which the evidence that would have challenged the consensus was gradually suppressed, not because it wasn't available, but because the organizational environment made its expression professionally costly. Have you ever been in a room where the consensus felt authoritative and later discovered that several people in the room had private doubts they hadn't expressed? Leave a comment. The false consensus effect operates differently across different organizational contexts, but its core structure is consistent. The consensus is produced by the social dynamics of the group rather than by the independent evaluation of evidence, and it is then used as evidence of its own correctness. In startup investment, the consensus that a company is worth a specific valuation is produced by the social dynamics of the funding community. When several prominent investors have invested at a given price, the consensus valuation is established. New investors evaluate the company partly by reference to the existing investors' judgment. The fact that they invested is taken as evidence of the quality of the investment. The consensus validates itself, and the relationship between the valuation and the underlying business is mediated through the social proof of other investors' decisions. This is the mechanism that produced the 2021 SPAC boom, the 2021 crypto peak, and the 2021 private equity valuation compression, each involving markets where consensus created its own momentum and was then used as evidence of its own soundness until the external shock that revealed the gap between the consensus valuation and the underlying value. False consensus is baked deep into human nature. Most people feel better about themselves when they are surrounded by people who think like they do, or they believe that most people think like they do. It's not always a bad thing, but sometimes false consensus and groupthink can lead to a disaster. Just consider pretty much every bubble the stock market has ever endured, and all the people who've lost their shirts by convincing each other about the latest can't-miss investment. If the specific mechanism, consensus as a social phenomenon rather than an empirical one, and the organizational conditions that cause them to diverge most dangerously, is what makes this channel worth your time, the like is the direct signal. The people who suffered most from the dot-com consensus collapse were not the analysts who had built it. Most of the analysts who had maintained buy recommendations during the run-up moved to other firms, to other sectors, or to other parts of financial services when the crash made their recommendations look credulous. The social and professional consequences they experienced were real, but bounded. The investors who had trusted the consensus, retail investors who had allocated retirement savings to internet stocks during the peak years, who had interpreted the unanimity of expert opinion as confirmation that the investment was sound, experienced consequences that were not bounded in the same way. The savings they had directed toward the consensus were not professionally recoverable. They were financially irrecoverable for many of them, in a time frame that mattered for their lives. The asymmetry is consistent across the false consensus cases this channel examines. The people whose professional incentives produce the consensus and who benefit from it while it persists are usually insulated from the worst consequences when it fails. The people who trusted the consensus without being part of the system that produced it bear the weight of the collapse. The practical intervention against false consensus in any organizational context is structural rather than exhortational. Telling people to speak up or to challenge assumptions is exhortational. It asks people to voluntarily override the social dynamics that produce false consensus while those dynamics remain in place. It rarely works. The structural interventions work by changing the conditions that produce the dynamics. Designated dissent, explicitly assigning one participant the role of critic with the mandate to argue against the consensus regardless of their personal view. The role assignment separates the criticism from the person making it, reducing the social cost of dissent. Anonymous input, collecting written assessments before group discussion begins, so the distribution of actual opinion is visible before the social dynamics of consensus formation take hold. When the group sees that several people have private doubts before the discussion creates the appearance of unanimity, the false consensus becomes legible. Pre-commitment to criteria, establishing in advance what evidence would change the consensus rather than evaluating evidence against the existing consensus. When the criteria are set before the evidence arrives, the evidence is harder to dismiss as anomalous. None of these prevent false consensus entirely. They reduce the probability that a false consensus will form and persist through the period when the information that challenges it is still actionable. The next episode looks at the friction that every plan underestimates, the resistance between what was decided and what actually happens. This content was developed with the support of artificial intelligence tools and underwent human review, editorial curation, and approval before publication. The analysis presented here is strictly educational and philosophical in nature, grounded in behavioral psychology and classical stoicism.